My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by Osmania University, Palamuru University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is the investment decision. Investment decision means choosing where to put money so the business can earn more in the future. It is also called capital budgeting. The main aim is to invest in projects that give more returns than the cost of investment. For example, a company has 10 lakhs rupees. It can either build a new factory, buy new machinery, or invest in a marketing campaign. Before choosing, the company checks how much profit each option can give, how much money is needed, how risky is the project, how long will it take to recover the money. Tools like NPV, net present value, IRR, internal rate of return, and payback period help in making this decision. Why it matters? A good investment decision increases company growth and value. A bad decision may lead to losses. Easy tip to remember. Investment decision is equal to spend today, earn more tomorrow. It's like planting a tree today for getting fruits in the future. Next important short question is 2 beta coefficient. The beta coefficient, beta, shows how much a company's investment or stock moves in comparison to the overall market. It is a measure of risk. If beta is equal to 1, the investment moves same as the market. If beta 1, the investment is more risky, moves more than the market. If beta 1, it is less risky, moves less than the market. Example: if the Sensex increases by 10% and a company's stock with beta is equal to 1.5 increases by 15%, it means the stock is more volatile than the market. Why beta is important? In capital budgeting, beta helps to adjust the discount rate using the CAP model, capital asset pricing model, to find the right rate of return for risky projects. Easy tip to remember. Beta tells us if your bike investment is going faster, slower or equal to traffic, market, dot. More beta is equal to more risk is equal to more return sometimes. Next important short question is 3 sensitivity analysis. Sensitivity analysis means checking how much a project's result, like profit or NPV, will change when one of the important inputs changes like cost, sales, or interest rate. It helps in finding which factor is most sensitive, critical, to success or failure of the project. It answers: what if things go wrong? For example, what if sales are 10% less? Or costs are 15% higher? Example: a company plans a project with an expected profit of 5 lakhs rupees. If the sales drop by 10% and profit becomes 2 lakhs rupees, it means the project is very sensitive to sales. Why it's useful? Managers can plan better by knowing which factor needs more attention or backup. Easy tip to remember. Sensitivity analysis is like testing how strong your umbrella is in different levels of rain. It's a key tool for smart investment decisions under uncertainty. Next important short question is 4 measurement of risk, problem. Measurement of risk, problem-based explanation. Problem: a company is considering 2 projects. The possible returns and probabilities are: return percent, probability for project A, probability for project B, 10% 0.2 0.1, 15% 0.5 0.4, 20% 0.30.5. Step 1. Calculate expected return, mean, for both projects. Project A is equal to 10% times 0.2 plus 15% times 0.5 plus 20% times 0.3 is equal to 2% plus 7.5% plus 6% equals 15.5%. Project B is equal to 10% times 0.1 plus 15% times 0.4 plus 20% times 0.5 is equal to 1% plus 6% plus 10% equals 17%. Step 2. Calculate variance and standard deviation for risk. Project A variance is equal to 6.05 plus 0.125 plus 6.075 is equal to 12.25. Standard deviation is equal to 12.25 is equal to 3.5%. Project B variance is equal to 4.9 plus 1.6 plus 4.5 is equal to 11. Standard deviation is equal to 3.32%. Conclusion. Even though Project B gives higher return, 17%, Project A has slightly higher risk, 3.5% versus 3.32%. Use this info for choosing safer versus higher return projects. Tip to remember. Risk is equal to uncertainty. Standard deviation tells you how shaky your returns might be. Next important short question is 5. Probability tree approach. The probability tree approach is a method used to show all possible outcomes of an investment decision and their related probabilities. It helps investors make better decisions under uncertainty and risk. Each branch of the tree represents a possible future event and its probability. At the end of each path, we get an expected return, which we use to compare different investment options. Example. A company plans to invest in a project with two possible outcomes. Success, profit 50,000 rupees, probability is equal to 0.6. Failure, loss 20,000 rupees, probability is equal to 0.4. We draw two branches. 1. Success 50,000 rupees times 0.6 is equal to 30,000 rupees. 2. Failure 20,000 rupees times 0.4 is equal to 8,000 rupees. Now, calculate expected value, EV. EV is equal to 30,000 rupees to 8,000 rupees is equal to 22,000 rupees. Easy tip. Think of the tree as a roadmap of outcomes. It shows where your money could go and how likely it is to happen. It's like guessing the weather but with money. Next unit 2. Long questions. First important long question is: explain the investment decision process with stages like project generation, evaluation, selection, and implementation. Investment decision process. The investment decision process helps a business decide where to invest money for better returns in the future. It is also known as the capital budgeting process. This process involves 4 main stages. 1. Project generation. This is the idea stage. Companies collect investment ideas from different departments, employees, or market trends. These ideas can be: expansion of business, launching a new product, replacing old machinery. Example, a textile company may think of setting up a new unit for making eco-friendly fabrics. 2. Project evaluation. Here, the company checks whether the project is financially profitable or not. It involves estimating future cash inflows, calculating cost of the project, using tools like NPV, net present value, IRR, internal rate of return, and payback period. Example, the eco-friendly fabric unit is expected to earn 10 lakhs rupees over 5 years, and its cost is 6 lakhs rupees. The company calculates whether it's worth investing. 3. Project selection. Out of all evaluated projects, only feasible and profitable projects are selected. The decision is based on financial return, risk involved, company goals, and available funds. Sometimes, due to limited budget, even good projects may be postponed. Example, the company may select only 1 out of 3 projects that has the highest NPV and lowest risk. 4. Project implementation. This is the action stage where the selected project is executed. It includes arranging funds, purchasing equipment, hiring staff, etc. Good planning and coordination are important to avoid delays or cost overruns. Example, after approval, the eco-fabric unit is set up within 6 months by hiring a project team. Summary tip. Remember the 4 steps as GSI. Generation, evaluation, selection, implementation. It's like planning a journey: where to go, idea, how to go, evaluate, choose best path, select, and start your trip, implement. Next important long question is: 2. Differentiate traditional and discounted cash flow, DCF, methods of capital budgeting with examples. Traditional versus discounted cash flow, DCF, methods of capital budgeting. Capital budgeting helps a company decide where to invest money for better returns. There are 2 main types of methods used. 1. Traditional methods. These methods do not consider the time value of money, i.e., 1 rupee today is equal to 1 rupee tomorrow. Types. Payback period method. Tells how long it takes to recover the investment. Accounting rate of return, ARR. Measures return using accounting profit. Advantages. Very simple and easy to calculate. Good for small or short-term projects. Limitations. Ignores time value of money. Ignores cash flows after payback period. Less accurate for long-term projects. Example. A project costs 1 lakh rupees and earns 25,000 rupee per year. Payback period is equal to 4 years. 2. Discounted cash flow, DCF, methods. These methods consider time value of money, meaning 1 rupee today is more valuable than 1 rupee in future. Types. Net present value, NPV. Calculates the value of future cash flows in today's terms. Internal rate of return, IRR. Finds the return rate where NPV is 0. Profitability index, PI. Ratio of present value of inflows to investment. Advantages. More realistic and accurate. Considers time value and risk. Helps in long-term decision-making. Limitations. Slightly complex. Requires knowledge of discount rate. Example. A project costs 1 lakh rupees and earns 30,000 rupees per year for 5 years. Using 10% discount rate, NPV comes to 13,730 rupees. Project is accepted. Key differences table. Feature traditional methods, DCF methods. Time value of money not considered. Accuracy less accurate, more accurate. Techniques payback, ARR, NPV, IRR, PI. Use for long-term not suitable, best suited. Remember, traditional is equal to simple but less accurate. DCF is equal to accurate but needs more effort. Like choosing a camera. Traditional is like a basic phone camera. DCF is like a DSLR, better focus, more clarity. Next important long question is 3. The NPV versus IRR debate, problem with solution. Question. A company is considering a project that costs 50,000 rupees. The cash inflows for 3 years are: Year 1, 20,000 rupees. Year 2, 25,000 rupees. Year 3, 20,000 rupees. Discount rate is equal to 10%. Find I. Net present value, NPV. 2. Internal rate of return, IRR. 3. Which method is better? Step-by-step solution. 1. Net present value, NPV. Formula. NPV is equal to total present value of cash inflows, initial investment. First, find the present value, PV, of each year's inflow using 10% discount factor. Year cash inflow 10% discount factor present value, PV. 120,000 rupees 0.909 18,180 rupees 20,000 times 0.909 to 25,000 rupees 0.8 to 20,650 rupees 25,000 times 0.8 to 6. 320,000 rupees 0.751 15,020 rupees 20,000 times 0.751. Total PV of inflows is equal to 18,180 rupees plus 20,650 rupees plus 15,020 rupees is equal to 53,850 rupees. Initial investment is equal to 50,000 rupees. NPV is equal to 53,850 rupees to 50,000 rupees is equal to 3,850 rupees, positive. So, the project is acceptable. 2. Internal rate of return, IRR. IRR is the rate where NPV is equal to 0. We try two rates to estimate IRR by trial and error. Try IRR at 14%. Year inflow 14% factor PV. 120,000 0.877 17,540 rupees. To 25,000 0.769 19,225 rupees. 320,000 0.675 13,500 rupees. Total PV is equal to 50,265 rupees, NPV 265 rupees, almost 2,000. So, IRR 14%. 3. Conclusion, NPV versus IRR. NPV is equal to 3,850 rupees, positive, accept. IRR is equal to 14% greater than 10% cost of capital, accept. Both say accept, but NPV is better because it gives exact profit value. Works better when there are multiple or uneven cash flows. Easy tip to remember. NPV is equal to how much profit? IRR is equal to how much return percent? Always trust NPV if confusion arises. Next important long question is 4 approaches for reconciliation. What is reconciliation in capital budgeting? In financial management, reconciliation means resolving the conflict between the results of two different evaluation methods, especially between NPV, net present value, and IRR, internal rate of return. Sometimes, NPV says accept the project and IRR says reject or vice versa. This creates confusion. That's where reconciliation helps us choose the correct method. Why NPV and IRR give different results? Here are some common reasons. 1. Different project sizes. A project with high returns but smaller investment may have a high IRR but lower NPV. 2. Uneven cash flows. If inflows vary a lot over the years, IRR may give misleading results. 3. Multiple IRRs. When cash flows change signs, positive left and right arrow, negative multiple times, IRR becomes unreliable. Approaches for reconciliation. There are three main approaches to solve conflicts between NPV and IRR. 1. Modified Internal Rate of Return (MIR). It solves the issue of multiple IRRs. It assumes cash inflows are reinvested at the firm's cost of capital, not at IRR. Helps give a more realistic return figure. Example: if IRR is 18%, but MIR is 13%, and the cost of capital is 10%, we accept the project if MIR greater than 10%. 2. NPV Profile Method. It is a graph between NPV and discount rates. Where NPV curve intersects the x-axis is the IRR. By plotting two projects on the same graph, we can see which one performs better at different discount rates. 3. Discount Rate Comparison. Directly compare IRR and required rate of return, cost of capital. If IRR cost of capital accept, but give final preference to NPV because it shows absolute profit. Final tip: if NPV and IRR disagree, always trust NPV. Because NPV tells how much money you'll actually gain. Easy trick. NPV is equal to profit value. IRR is equal to return percent. MIR is equal to realistic return. Reconciliation helps you take smarter investment decisions. Next important long question is 5. Capital budgeting decision under risk and uncertainty. Explain and solve using risk-adjusted discount rate or certainty equivalent approach. What is risk and uncertainty in capital budgeting? In real life, when a company invests in a project, the future cash flows are not guaranteed. They may increase or decrease due to market changes, inflation, political issues, or economic conditions. Risk is equal to outcomes are unknown, but probabilities are known. Uncertainty is equal to outcomes and probabilities are both unknown. That's why financial managers use special methods to make safe decisions. Two popular methods are 1. Risk-adjusted discount rate, RADR. In this method, instead of using the normal discount rate, like 10%, we use a higher rate, say 15%, for risky projects. Formula: NPV is equal to sigma, expected cash flow, 1 plus risk-adjusted rate, initial investment. Example: project cost is equal to 50,000 rupees. Expected cash inflows is equal to 20,000 rupee per year for 3 years. Risk-adjusted discount rate is equal to 15%. NPV is equal to negative 4,343.2 rupees. Since NPV is negative, reject the project. 2. Certainty equivalent (CE) approach. Here, we reduce the cash flows themselves based on how certain they are. Safer cash flows are adjusted closer to 100%, while riskier ones may be adjusted to 80%, 60%, etc. Formula: NPV is equal to sigma, cash flow times certainty equivalent factor, 1 plus risk-free rate, initial investment. Example: Year 1 inflow is equal to 30,000 rupees times 0.8 is equal to 24,000 rupees. Year 2 inflow is equal to 30,000 rupees times 0.6 is equal to 18,000 rupees. Risk-free rate is equal to 10%. Cost is equal to 40,000 rupees. NPV is equal to negative 3,305.8 rupees. NPV is negative, reject the project. Final tip: if a project is risky, adjust the rate or the cash flow to make better decisions. RADR is equal to adjust the discount rate. C is equal to adjust the cash flows. Both help in making safer investment choices under uncertainty. Next important long question is 6. A company is considering investing in a project that costs 4 lakhs rupees. The estimated salvage value is 0, tax rate is 55%. The company uses straight line depreciation and proposed project has cash flows before tax CFBT as follows. Year CFBT, Rs. 1 lakh. 2 1 lakh. 3 1 lakh 50,000. 4 1 lakh 50,000. 5 2 lakhs 50,000. Determine the following. 1. Payback period. 2. ARR. 3. NPV at 15%. 4. PL at 15%. Let's solve step by step using simple words. Given data. Initial investment is equal to 4 lakhs rupees. Salvage value is equal to 0 rupees. Project life is equal to 5 years. Tax rate is equal to 55%. Depreciation, straight line, is equal to 4 lakhs rupees. 5 is equal to 80,000 rupee per year. Discount rate is equal to 15%. Year CFBT. 1 lakh. 2 1 lakh. 3 1 lakh 50,000. 4 1 lakh 50,000. 5 2 lakhs 50,000. Step 1. Calculate CFAT, cash flow after tax. Formula. CFAT is equal to CFBT depreciation times 1 tax rate plus depreciation. Let's calculate year-wise. Year 1 is equal to 1 lakh to 80,000 times 0.55 plus 80,000 is equal to 20,000 times 0.45 plus 80,000 is equal to 9,000 plus 80,000 is equal to 89,000 rupees. Year 2, same as year 1, 89,000 rupees. Year 3 is equal to 1,50,000 to 80,000 times 0.45 plus 80,000 is equal to 70,000 times 0.45 plus 80,000 is equal to 31,500 plus 80,000 is equal to 1,11,500 rupees. Year 4, same as year 3, 1,11,500 rupees. Year 5 is equal to 2,50,000 to 80,000 times 0.45 plus 80,000 is equal to 1,70,000 times 0.45 plus 80,000 is equal to 76,500 plus 80,000 is equal to 1,56,500 rupees. 1. Payback period. Find how many years it takes to recover 4 lakhs rupees. Year CFAT, cumulative CFAT. 1. 89,000, 89,000. 2. 89,000, 1,78,000. 3. 1,11,500, 2,89,500. 4. 1,11,500, 4,01,000. Payback period is equal to 3 plus 4 lakhs to 2,89,500, 1,11,500 is equal to 3 plus 1,10,500 slash 1,11,500, 3.99 years. 2. ARR, accounting rate of return. Formula. ARR is equal to average annual accounting profit initial investment times 100. Accounting profit is equal to CFAT depreciation. Year CFAT depreciation profit. 1. 89,000, 80,000, 9,000. 2. 89,000, 80,000, 9,000. 3. 1,11,500, 80,000, 31,500. 4. 1,11,500, 80,000, 31,500. 5. 1,56,500, 80,000, 76,500. Total profit is equal to 1,57,500 rupees. Average profit is equal to 1,57,500 rupees. 5 is equal to 31,500 rupees. ARR is equal to 31,500 / 4 lakhs times 100 is equal to 7.88%. 3. NPV at 15%. Use PV factor table or calculator. Here CF at PV factor at 15% present value. 189,000 0.8696 77,394. 289,000 0.756 167,293. 3 1,11,500 0.6 575 4 1,11,500 0.57 1863,755. 5 1,56,500 0.497 77,812. 3,59,534 rupees. NPV is equal to total PV initial investment is equal to 3,59,534 rupees to 4 lakhs rupees is equal to negative 40,466 rupees. Since NPV is negative, reject the project. 4. Profitability index, PI, at 15%. Formula, PI is equal to total present value initial investment. I is equal to 3,59,534 rupees. 4 lakhs rupees is equal to 0.8988. Since PI 1, reject the project. Final summary. Metric result. Payback period 3.99 years. ARR 7.88%. NPV at 15%, 466. I at 15%. 0.8988. Project is not financially viable.